Question 1. An individual who provides investment advice to clients for compensation, but does not have physical custody of client funds or securities, must register as an investment advisor, IA, under the Uniform Securities Act, USA, if they meet which of the following criteria? A. They are regulated by the Securities and Exchange Commission, SEC. B. They solely advise institutional clients. C. They meet the ABC test, advice, business, and compensation. D. They only advise clients on a one-time basis. Answer: C. They meet the ABC test, advice, business, and compensation. An individual must register as an investment advisor under the Uniform Securities Act if they satisfy the ABC test, providing advice about securities, doing so as a regular business activity, and receiving compensation for that advice. This core definition ensures that those acting as investment advisors are regulated to protect the public. For example, a financial planner who charges a fee for creating investment plans for individuals would likely meet all three criteria. Always remember the ABCs when identifying an investment advisor. Question 2. Under the Uniform Securities Act, which of the following actions taken by an investment advisor would be considered unethical or a prohibited practice? A. Charging a reasonable hourly fee for financial planning services. B. Exercising discretion in a client's account without prior written authorization. C. Providing general economic forecasts to all clients. D. Recommending diversified mutual funds to a client with a long-term goal. Answer: B. Exercising discretion in a client's account without prior written authorization. Investment advisors, IAs, and their investment advisor representatives, IARs, are fiduciaries, meaning they must always act in the best interest of their clients. Exercising discretion, which involves making investment decisions on behalf of a client without their explicit approval for each trade, is a significant responsibility and requires prior written authorization from the client. Failing to obtain this authorization is a serious breach of fiduciary duty and a prohibited practice under the Uniform Securities Act. This rule helps protect clients from unauthorized transactions and ensures transparency in the advisory relationship. Question 3. An investment advisor registered under the Investment Advisors Act of 1940 is generally required to file which form with the SEC? A. Form 10-K. B. Form ADV. C. Form U4. D. Form BD. Answer: B. Form ADV. Investment advisors who are registered with the SEC must file Form ADV, which is the primary registration document for investment advisors. This form provides comprehensive information about the advisor's business, including its services, fees, disciplinary history, and any conflicts of interest, making it available to the public for transparency. Form ADV is updated annually and helps clients make informed decisions when choosing an advisor. Understanding this key filing requirement is crucial for navigating the regulatory landscape of investment advisors. Question 4. Which of the following best describes the concept of unbundling in the context of investment advisory services? A. Offering a single, comprehensive fee for all advisory and brokerage services. B. Separating advisory fees from brokerage commissions, allowing clients to pay for each service independently. C. Combining various investment products into a single portfolio for diversification. D. Providing personalized investment advice based on a client's individual needs. Answer: B. Separating advisory fees from brokerage commissions, allowing clients to pay for each service independently. Unbundling, in the context of investment advisory services, refers to the practice of separating the advisory fees charged by an investment advisor, IA, from the brokerage commissions or other transaction-related costs. This allows clients to clearly see and pay for the specific advisory services they receive, distinct from the costs of executing trades. This practice enhances transparency regarding fees and can help clients evaluate the value of the advice independently from the transaction costs. It's important for IAs to clearly disclose all compensation arrangements to clients. Question 5. Under the Uniform Securities Act, which of the following would not be considered a security? A. An investment contract. B. A certificate of interest in a profit-sharing agreement. C. An insurance policy with a fixed death benefit. D. A variable annuity. Answer: C. An insurance policy with a fixed death benefit. The Uniform Securities Act broadly defines a security to include common stocks, bonds, mutual fund shares, and various types of investment contracts where an individual invests money in a common enterprise with the expectation of profits to be derived from the efforts of others. However, traditional fixed life insurance policies and fixed annuities, which offer guaranteed benefits and do not expose the policyholder to investment risk, are generally exempt from the definition of a security. A variable annuity, on the other hand, is considered a security because its value fluctuates based on the performance of underlying investments, thereby carrying investment risk. Question 6. A client approaches an investment advisor seeking advice on investing for retirement. The client is 30 years old, has a stable income, and expresses a high tolerance for risk. Based on this information, which of the following asset allocations would generally be most suitable? A. 80% bonds, 20% equities. B. 50% cash, 50% money market funds. C. 70% equities, 25% bonds, 5% cash. D. 95% fixed annuities, 5% mutual funds. Answer: C. 70% equities, 25% bonds, 5% cash. Suitability is a core principle for investment advisors, requiring recommendations to align with a client's specific financial situation, risk tolerance, and investment objectives. For a 30-year-old with a high risk tolerance and a long-term goal like retirement, an asset allocation heavily weighted towards equities, stocks, is generally considered suitable. Equities offer higher growth potential over long horizons, which aligns with the client's age and risk tolerance, while including some bonds and cash helps provide diversification and liquidity. This approach allows the portfolio to potentially capture significant market appreciation over many years. Question 7. The Capital Asset Pricing Model, CAPM, calculates the expected return of an asset based on its sensitivity to market risk. The component of CAPM that measures this sensitivity is known as A. Alpha. B. Standard deviation. C. Beta. D. R-squared. Answer: C. Beta. The Capital Asset Pricing Model, CAPM, is a widely used model that calculates the expected return for a security or portfolio, considering its systematic risk. Beta is the core component within CAPM that measures a security's volatility in relation to the overall market. A beta of 1 means the security moves with the market, while a beta greater than 1 indicates higher volatility. For example, a stock with a beta of 1.5 would be expected to move 1.5 times as much as the market. Understanding beta helps investors gauge how much market risk a particular investment adds to a portfolio. Question 8. Under the Uniform Securities Act, an individual who represents an issuer in effecting transactions in that issuer's securities with the public is generally defined as an A. Investment Advisor Representative, IAR. B. Agent. C. Broker-dealer. D. Administrator. Answer: B. Agent. Under the Uniform Securities Act, an individual who represents an issuer, the company issuing the securities, in the sale of its securities to the public is typically defined as an agent. This means they are involved in the actual transaction process, selling the issuer's securities. For example, an employee of a company who sells newly issued stock directly to investors on behalf of that company would be considered an agent. It's important to distinguish an agent from a broker-dealer, who is generally a firm engaged in the business of effecting securities transactions for others or for its own account. Question 9. An investment advisor discusses the potential benefits of a municipal bond with a client. Which of the following statements about municipal bonds is generally true? A. Their interest income is always exempt from federal, state, and local taxes. B. They are issued by corporations to raise capital. C. Their yield to maturity is usually higher than that of comparable corporate bonds. D. Their interest income is generally exempt from federal income tax, but may be subject to state and local taxes. Answer: D. Their interest income is generally exempt from federal income tax, but may be subject to state and local taxes. Municipal bonds are debt securities issued by state and local governments or their agencies to finance public projects. A key characteristic that makes them attractive to certain investors is that their interest income is generally exempt from federal income tax. However, whether it is exempt from state and local taxes depends on where the bondholder resides and where the bond was issued. For example, a New York resident buying a New York municipal bond might receive triple tax-exempt interest. This tax benefit often results in municipal bonds having a lower yield than taxable corporate bonds with similar risk. Question 10. Which of the following retirement plans is typically considered a non-qualified plan? A. 401k. B. 403b. C. Traditional IRA. D. Deferred compensation plan. Answer: D. Deferred compensation plan. Non-qualified retirement plans do not meet the strict requirements set forth by ERISA, Employee Retirement Income Security Act, and the IRS, meaning they do not receive the same tax benefits as qualified plans. Deferred compensation plans, which are often used by highly compensated executives, allow an employee to defer receiving a portion of their salary until a later date, typically retirement. Unlike qualified plans like 401k, 403b, and IRAs, these plans can discriminate in favor of certain employees and generally do not have immediate tax deductibility for contributions by the employer, nor are employee deferrals immediately tax deductible. Question 11. An investment advisor's fiduciary duty to a client includes all of the following except: A. Acting in the client's best interest. B. Disclosing all material facts and conflicts of interest. C. Minimizing fees and commissions to the lowest possible amount. D. Ensuring recommendations are suitable for the client's objectives and risk tolerance. Answer: C. Minimizing fees and commissions to the lowest possible amount. A core concept for investment advisors, IAs, is their fiduciary duty, which means they must act solely in their client's best interest. This duty encompasses making suitable recommendations, disclosing all material facts and conflicts of interest, and managing conflicts fairly. While an IA should strive for reasonable fees and efficient execution, their fiduciary duty does not explicitly require them to always find the absolute lowest fees or commissions available, as long as the chosen costs are reasonable and disclosed, and the overall recommendation remains suitable. The emphasis is on acting in the client's overall best financial interest, not just the lowest cost. Question 12. A client has established a revocable living trust. Which of the following statements about this type of trust is true? A. The assets placed in the trust are exempt from federal estate tax upon the grantor's death. B. The grantor surrenders control over the assets once they are placed in the trust. C. The trust avoids probate, and the grantor can modify or terminate it during their lifetime. D. The trust becomes irrevocable upon its creation. Answer: C. The trust avoids probate, and the grantor can modify or terminate it during their lifetime. A revocable living trust is a popular estate planning tool where the grantor, the person who creates the trust, transfers assets into the trust but retains control over them during their lifetime. The key advantage of a revocable trust is that it allows the assets to bypass the probate process upon the grantor's death, which can save time and money. Furthermore, as the name suggests, the grantor can amend, revoke, or terminate the trust at any point while they are alive and competent. This flexibility makes it a versatile tool for managing assets and facilitating their transfer upon death. Question 13. Which of the following is considered a leading economic indicator? A. Consumer Price Index, CPI. B. Gross Domestic Product, GDP. C. Building permits. D. Unemployment rate. Answer: C. Building permits. Economic indicators are data points used to assess the health and direction of an economy. Leading indicators are those that tend to change before the economy as a whole changes, providing a predictive signal of future economic activity. Building permits, which reflect future construction activity, are a classic example of a leading indicator because an increase in permits often precedes an increase in housing starts and broader economic expansion. In contrast, GDP and CPI are coincident or lagging indicators, describing current or past economic conditions. Question 14. An investor purchases a call option on ABC stock. This investor expects the price of ABC stock to A. Decrease significantly. B. Remain stable. C. Increase. D. Fluctuate unpredictably. Answer: C. Increase. A call option gives the holder the right, but not the obligation, to buy an underlying asset, like a stock, at a specified price, the strike price, on or before a certain date. Investors purchase call options when they anticipate an increase in the price of the underlying stock. If the stock price rises above the strike price, the call option gains value, allowing the investor to profit from the appreciation without owning the shares outright. Conversely, if the stock price falls, the option may expire worthless. Question 15. What is the primary difference between an open-end management company, mutual fund, and a closed-end management company? A. Open-end funds trade on exchanges, while closed-end funds do not. B. Open-end funds issue a fixed number of shares, while closed-end funds continuously issue new shares. C. Open-end funds are continuously offered and redeemed by the fund, while closed-end funds trade on secondary markets. D. Open-end funds can invest in any type of security, while closed-end funds are limited to bonds. Answer: C. Open-end funds are continuously offered and redeemed by the fund, while closed-end funds trade on secondary markets. The fundamental distinction between open-end and closed-end management companies lies in their capital structure and how their shares are traded. Open-end funds, commonly known as mutual funds, continuously issue new shares when investors purchase them and redeem existing shares when investors sell them back to the fund, always at their net asset value, NAV. Conversely, closed-end funds issue a fixed number of shares in an initial public offering, IPO, and these shares then trade on secondary markets like stock exchanges, where their price is determined by supply and demand, often trading at a premium or discount to their NAV. Question 16. The concept of soft dollars in the investment advisory business refers to A. Cash payments made by an investment advisor to clients for referrals. B. Arrangements where an investment advisor uses client commission dollars to pay for research and brokerage services. C. The practice of discounting advisory fees for less affluent clients. D. Payments received by an investment advisor from mutual funds for selling their shares. Answer: B. Arrangements where an investment advisor uses client commission dollars to pay for research and brokerage services. Soft dollars refer to arrangements where an investment advisor directs client brokerage transactions to a broker-dealer in exchange for research, analytical, or other brokerage services provided by that broker-dealer. Essentially, the advisor uses the commissions generated from client trades to pay for services that benefit their advisory practice, rather than paying cash for those services. While permissible under certain conditions, such arrangements must be disclosed to clients, and the services received must be for the direct benefit of the client's accounts, not just the advisor's general business. Question 17. The time value of money concept states that a dollar received today is worth more than a dollar received in the future due to its potential earning capacity. Which of the following best illustrates this principle? A. Calculating the present value of a future cash flow. B. Comparing the real return of an investment to its nominal return. C. Analyzing the impact of inflation on purchasing power. D. Determining the risk-adjusted return of a portfolio. Answer: A. Calculating the present value of a future cash flow. The time value of money is a core financial concept emphasizing that money available today is more valuable than the same amount in the future because it has the potential to earn interest or returns. Calculating the present value of a future cash flow directly illustrates this principle by discounting a future amount back to its current equivalent, recognizing the opportunity cost of not having that money today. For example, $1,000 received in 5 years is worth less than $1,000 received today, because today's $1,000 could be invested and grow over those 5 years. Question 18. Under the Uniform Securities Act, which of the following is most likely to be considered a federal covered investment advisor? A. An advisor whose only clients are residents of a single state and who manages less than $25 million in assets. B. An advisor with $120 million in assets under management, AUM. C. An advisor who provides advice solely to insurance companies. D. An advisor whose business is limited to advising on commodity futures. Answer: B. An advisor with $120 million in assets under management, AUM. A federal covered investment advisor is an investment advisor that is registered with the SEC rather than with state securities authorities. One of the primary triggers for a SEC registration is managing a certain threshold of assets under management, AUM, typically $100 million or more. Therefore, an advisor managing $120 million in AUM would generally be considered a federal covered investment advisor and subject to SEC oversight, not state registration. This distinction is crucial for understanding the appropriate regulatory body for an advisor. Question 19. An investor holds a portfolio consisting entirely of common stocks. The risk that the overall stock market declines, impacting all stocks in the portfolio, is known as A. Business risk. B. Financial risk. C. Systematic risk. D. Unsystematic risk. Answer: C. Systematic risk. Systematic risk, also known as market risk or non-diversifiable risk, is the risk inherent to the entire market or market segment. It affects all investments to some degree and cannot be eliminated through diversification. Examples include interest rate changes, inflation, or geopolitical events that impact the entire economy or stock market. In contrast, unsystematic risk, or specific risk, is unique to a particular company or industry and can be reduced through diversification. Question 20. Under the Uniform Securities Act, how long must an investment advisor maintain records of client accounts and transactions? A. 3 years. B. 5 years. C. 7 years. D. Permanently. Answer: B. 5 years. Under the Uniform Securities Act, investment advisors, IAs, are typically required to maintain records, such as client account statements, transaction records, and correspondence, for a period of 5 years. This retention period is crucial for regulatory oversight, allowing securities administrators to review an advisor's compliance with regulations and to investigate any potential misconduct. For example, if a client files a complaint about a transaction, the advisor must have the records readily available for review. Remember this specific timeframe for compliance purposes. Question 21. Which of the following best defines the term prudent investor rule in the context of fiduciary responsibility? A. An investor must always choose the lowest risk investments available. B. Fiduciaries must invest assets with the care, skill, and caution that a prudent person would exercise. C. All investment decisions must guarantee a positive return. D. Fiduciaries are only permitted to invest in government-backed securities. Answer: B. Fiduciaries must invest assets with the care, skill, and caution that a prudent person would exercise. The Prudent Investor Rule, which has evolved from the Prudent Man Rule, is a standard for fiduciaries, such as investment advisors, managing investment portfolios for others. It requires them to act with the care, skill, and caution that a prudent investor would in managing their own portfolio, considering the purposes, terms, distribution requirements, and other circumstances of the trust or account. This rule emphasizes overall portfolio risk and return characteristics rather than focusing on the risk of individual investments, encouraging diversification and modern portfolio theory principles. It underscores the importance of a thoughtful and disciplined investment process. Question 22. What is the primary purpose of a Section 529 plan? A. To provide tax-deferred growth for retirement savings. B. To save for healthcare expenses with tax-free distributions. C. To save for qualified higher education expenses with tax-advantaged growth and distributions. D. To allow employees to defer a portion of their compensation until retirement. Answer: C. To save for qualified higher education expenses with tax-advantaged growth and distributions. A Section 529 plan, often referred to as a qualified tuition program, is a tax-advantaged savings plan designed specifically to encourage saving for future higher education expenses. Contributions grow tax-deferred, and qualified withdrawals for expenses such as tuition, fees, books, and room and board are tax-free. For instance, parents saving for their child's college education can contribute to a 529 plan and potentially benefit from significant tax advantages when the funds are used for approved educational costs. This plan is a popular vehicle for educational funding. Question 23. An investment advisor representative, IAR, is moving from one registered investment advisor, RIA, to another. Under the Uniform Securities Act, who is responsible for notifying the administrator of this change? A. Only the departing IAR. B. Only the new RIA. C. Both the departing IAR and the new RIA. D. Only the administrator initiates the notification. Answer: C. Both the departing IAR and the new RIA. When an investment advisor representative, IAR, terminates employment with one registered investment advisor, RIA, and begins employment with another, both the departing RIA and the new RIA are generally required to notify the administrator. This dual notification ensures that the state securities regulator is fully aware of the IAR's employment status changes, which is crucial for maintaining accurate records and regulatory oversight. This shared responsibility helps to protect the public by ensuring that the IAR's registration status is always current and properly managed. Question 24. Which of the following is considered the riskiest type of bond? A. U.S. Treasury bond. B. Investment-grade corporate bond. C. High-yield, junk, bond. D. Municipal bond. Answer: C. High-yield, junk, bond. High-yield bonds, also known as junk bonds, are debt securities issued by companies or municipalities with lower credit ratings, typically below investment grade. Due to the higher risk of default associated with these issuers, these bonds must offer a higher interest rate, yield, to attract investors. While they offer the potential for higher returns, they also carry significantly greater credit risk compared to safer investments like U.S. Treasury bonds, investment-grade corporate bonds, or even most municipal bonds. Always remember that higher yield often comes with higher risk. Question 25. Under the Investment Advisors Act of 1940, which of the following records must be maintained by an investment advisor at its principal office for at least 6 years? A. Articles of Incorporation. B. Journals of Original Entry and General Ledger. C. Client Suitability Questionnaires. D. All records are required to be kept for 5 years. Answer: B. Journals of Original Entry and General Ledger. The Investment Advisors Act of 1940 and its rules specify various record-keeping requirements for SEC-registered investment advisors. While many records are generally required to be kept for 5 years, certain foundational accounting records, such as journals of original entry, e.g., cash receipts and disbursements, purchases and sales, and the general ledger, must be preserved for 6 years. These critical financial records provide a detailed history of the advisor's transactions and financial position, supporting regulatory oversight and audits. Remember that specific record types may have different retention periods.